Hello friends. Last week in my video, we discussed how the outlook of the market depended on the banking space because of 34.35% weightage that banking stocks commanded in the Nifty itself. Now, that hypothesis worked out pretty well, and in this video, we are going to take that forward and see what really to expect in the market because markets are now currently precariously poised. So let's dive right into the video, and on your screen right now is the weekly market roundup, and what you can see is how the fall was led by the broader based Nifty 50 itself, with Bank Nifty leading up the rear. Now the US dollar index, the Dixie, fell last week, and that basically gave the emerging markets including India some amount of respite because a strong US dollar and a strong US market are both negative for the Indian markets because there is that feeling that money will flow out of the Indian markets and go into the US markets. The Indian rupee also gained versus the US dollar after hitting lifetime lows in the recent past. Indian 10-year benchmark bond yields rose just about a tad, nothing significant out there, and the weak dollar pushed up prices of commodities, particularly natural gas, because the winter season is natural gas witnesses a huge demand spike, being the fuel of choice for indoor heating, and there are reports about a polar vortex in North America and Europe. NSE market capitalization went up by 0.5%, but that's nothing compared to the over 5% decline that we saw in the prior week. So we still need to be a bit careful out there. MWPL went up by 90 basis points, which is routine ahead of expiry, and US headline indices fell across the board and provided headwinds to our markets. Now, friends, I come to the ratio chart of the Bank Nifty versus the Nifty 50. Why do we need to look at that? Because of what you're seeing on your screen right now. Look at the sheer humongous weightage enjoyed by the banking space in the Nifty itself. So whichever way this sector goes, it is a swing sector and takes the Nifty with itself. Coming to the ratio chart on your screen, this is the fourth consecutive bullish candle that you've seen on the ratio chart. However, there is a long upper shadow which tells you that at higher levels there was selling pressure out there. And for this ratio chart to indicate sustained bullishness, we basically need to see this ratio chart going above 2.35, if not 2.45 on a sustained trading basis. Now, friends, I come to our in-house indicator and I start with the market-wide position limits, or MWPL. There's a video here which will explain to you why I think that it is one of the most important studies that you can basically incorporate in your study regimen. So now the MWPL chart on your screen is showing a very marginal and mild advance. This is routine ahead of expiry, but the kind of almost flatlining of the MWPL tells you that there's extreme caution. Not surprising, markets are falling and therefore mark-to-market payouts have to be made. You need to watch this space. I update the MWPL every day on my social media accounts. Do connect with me. My contact coordinates are at the fag end of this video, in the pinned comment below, and in the description below this video. Now, friends, I come to the stock and index futures turnover. This is 20 weeks data of all three expiries. So it is February, March, and April. Index futures turnover actually fell last week, whereas individual stock futures turnover rose. Now, rising turnover, is it bullish? Under normal circumstances, yes, but do remember this is expiry. There is a closing out of trades in the February futures and reinitiation of the same trade in March. So turnover tends to be higher ahead of expiry. Otherwise, where turnover is concerned, the spot market turnover has remained below the 1 lakh crore mark for 7 days in a row. That's not exactly very healthy. Let's also not forget that futures and options turnover also has been coming down from October after SEBI's new norms have come in. STT has gone up, lot sizes and indices have gone up, and margins have become a lot more stringent. Now I come to the NSE advanced decline ratio. After the price itself, this is a leading indicator that also tells you which way the winds are blowing. Now last week NSE narrowed the amount of declines that it was clocking in the recent past. It fell a little over 0.5%. The advanced decline ratio also rose smartly from almost a 20-week period low to 1.38. So for every 100 losers, there were 138 gainers. That tells me that intraday traders were showing a little more optimism as compared to the prior week. Now, as long as the ratio remains above 1, you have a fighting chance to the bulls to come back and grab the initiative. Now, friends, look at the basis chart. Basis is nothing but the premium or discount prevalent in the future compared to spot. Now, this is Nifty and Bank Nifty. Both the indices are showing a routine decline in basis ahead of expiry. Do remember, on expiry day, future and spot prices converge or become one and the same. So falling basis is routine in the run up to expiry, but it should not invert, which means the future should not trade at a discount to spot. Let's watch out for that. Now, friends, our in-house indicator, the impetus, what you are seeing is a sharp decline in impetus. That means last week's fall was on very low momentum. Now, why is the momentum low? Do remember the MWPL itself is almost flatline. Volumes have fallen. Traders are basically in a kind of a hibernation mode, which is why there is no force in the market. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. You won't find this anywhere on the internet, and it stood the test of time for almost 3.5 years now. Now take a look at what's happened. The Nifty has lost 0.5% last week as compared to little over 2.5% in the prior week. The LWTD has also risen sharply, but it still remains minus. At minus 0.14, it tells you that what we can expect is possibly improved short covering, but fresh buying may be very, very limited. Now, why can we expect improved short covering? Remember, this is the expiry week up ahead. More shorts are squared up as compared to being rolled over, and more longs are rolled over as compared to being squared up. So the retail guy invariably is more comfortable buying, and therefore short covering is something that is routine ahead of expiry, which is why the LWTD has gone down. But do remember, it's still in the minus. Now, these indicators are also updated on my social media accounts. Do connect with me there, please. Friends, I now come to the bond markets, which is very close to my heart. This market is the money tap or the money fountain, source of all finance for price discovery mechanism for all the other asset classes. Now, the bond yields in India have just about barely, in the third decimal, risen a tad. That tells you that bond prices have marginally come down. Now, what does it tell you? It tells you that the bond markets are not really very gung-ho about a very sharp decline in the coupon rates or the interest rates in the coming future. Sure enough, there might be reduction in coupon rates, but do also remember, as I have been telling you on my Telegram channel, this is the one place where I put out all our views, news, research, data points, etc. because this is one platform which allows upload of any kind of file format. So I've been telling you that cost of funds is likely to go up. I hope you've studied Dick Stoken's books that I have referred to you online for free. Please do make it a point to upgrade your knowledge database there, because you'll have an unfair advantage over others who don't. Now take a look at the weekly chart of the Indian 10-year benchmark bond yields. This attempted to rise a little, although just a tad. And that tells you that bond prices might just remain under pressure if at all they manage to rise. Friends, the bond market's done. I now come to the Bank Nifty, and this index, as you can see on the daily chart on your screen, fell on 3 out of 5 trading sessions. It surrendered 0.24% in spot. Price is below its monthly average and the neckline of a very broad, lazy head and shoulder patterns neckline, and that itself is a bearish indicator. The previous swing low the Bank Nifty made in January this year has not been tested or even violated yet. That tells you that in relative comparison, the Bank Nifty seems to be a little more stronger than the Nifty 50, which has breached that swing low. The short-term outlook is nervous, of course, because the price is still below its moving average and the neckline. Take a look at the weekly chart on your screen. It shows you a very tiny candle, which is an inverted hammer. So that indicates that there is pressure on advances. The price is below its 25-week exponential moving average, which is a proxy for 6-month long holding on cost of an average bull. So the medium-term outlook also remains nervous. For the bulls to return convincingly, the 50,750 hurdle must be overcome, that too with higher volumes forcefully, thereby absorbing all the overhead supply that might be coming on offer from retail traders who are trapped at higher levels. Friends, in the week before last, this index was number 5 on the most volatile counters list as per statistical beta rankings I maintain in-house. It went up by 1 notch to number 4. That's not really good. Rising volatility is always a worrying point for the retail guy. Last week, I advocated an estimated range between 50,900 on the upside and 47,325 on the downside. It held perfectly well. In the coming week, the estimated range is between 50,725 on the upside and 47,225 on the downside. The wide range is because of increased volatility. In addition to this range advocated, please also take a look at these free pivot levels of daily, weekly and monthly duration, which I update on our Telegram, WhatsApp channel, etc. Do connect with me on our social media account, and also check out this free tutorial video about how to use the pivot levels for laser precise entry and exit and thereby increasing your trading profits. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell on 3 out of 5 trading sessions. It fell more than the Bank Nifty because it surrendered 0.58% last week. The price, as you can see on the daily chart on your screen, is below its monthly average, and the weekly low was the lowest it made after 6th of June 2024. So that makes it almost 9-month lows. If you add the cost of carry, which is the rollover cost, and cost of funds, which Dick's Tokens books have taught you, you will realize that the bulls are deeply underwater in deep losses. And that is not shown on the charts because the chart only tells you the ruling price, not the rollover cost and the cost of funds that you're paying. Let's take a look at the weekly chart that tells you that the price is staying below the support trend line of a descending or a bearish triangle, and it is also staying below a 25-week exponential moving average, which doubles up as a 6-month long holding on cost of an average bull. So the medium term outlook is nervous. Now, even for a pullback rally, a technical pullback, the Nifty spot must bounce above the 23,300 on a sustained closing basis. For a complete trend reversal, you will need to have the Nifty trading convincingly with very high volumes above the 23,850 levels. That is a long shot. Now, being an expiry week, volatility will rise and the bid and offer spreads will also go wider, which means your take-home profits might just contract. Please maintain Hacienda hedges. I've explained to you in this video what these Hacienda hedges are. Hyperlinks to all videos that I want you to see are in the pinned comment below and in the description below this video. Also maintain very strict stop losses, please. Now, in the week before last, this index was number 11 on the statistical beta rankings that I maintain in-house. It slipped 5 notches to number 16. Not a surprise. The intra-week range was very narrow. Now, last week I advocated an estimated range between 23,600 on the upside and 22,275 on the downside, which held thanks to the very narrow range that we saw the Nifty trade within. In the coming week, I estimate a range between 23,425 on the upside and 22,175 on the downside. Here again, please watch the daily, weekly, and monthly pivots that I upload free on our channels, as also this video on how to use our pivot levels. Friends, I now come to the last bit of statistical analysis where we'll gauge the retail risk appetite by the turnover they contribute in the 4 segments in the derivative space. The index futures turnover went up by 1 basis point, shown as a blue line. Stock futures turnover went up by 32 basis points, shown as a red line. Why is that? Now, this is nothing but the rollover process. Traders are closing out their trades in February and initiating them in March. So that is resulting in higher turnover. Where options are concerned, which are lower volatile and lower capital intensive than futures, index options show a big decline in turnover contribution by 87 basis points, shown as a green line. And stock options, which are relatively more volatile than index options, are showing turnover contribution go up by 54 basis points, shown as a purple line. The risk appetite appears to be higher thanks to expiry, but the fact that traders are rolling over their trades to the next settlement also is a sign of risk appetite. So net, I would say that the retail is still hopeful. It is still rolling over its trades and latching on to hope that the markets will rise. Friends, I now come to my weekly trading strategy. Is going to remain simple, unchanged. As long as something works, don't fix it. Let's not reinvent the wheel because the current wheel is working well. Theta decay remains my strategy of choice, especially on interest rate sensitives, public sector undertakings, energy, and power stocks. Now, trading focus remains on public sector units. Why? I've explained to you in this video as to why I prefer trading, both long and short, in public sector units. They have some statistical advantage over the private sector stocks. Outsized moves in either direction are likely because a whole lot of emotional and financial commitments have gone into these stocks in the recent months. Industrial metals may see a limited upside due to the month-end short covering, but higher levels will meet selling. So that price movement will be mirrored by shares of metal mining companies. Bullion remains a good long-term investment, and this video, if you watched this video, please watch it again. If you haven't watched this video, please watch this video afresh. Why am I emphasizing on buying bullion in the physical format? If you're reading what is happening, if you're watching videos, etc., on what is happening about the fears in the US market, the fears in the British central bank, is there really as much gold as there should be, as it shows in the account books? Is it backed by physical gold? Yes or not? There is panic. Delivery is available after a fortnight, in sometimes even 3 weeks delay, because there's a shortage of physical gold. Now, that is exactly why, to rule out any uncertainty, I made this video about how you can buy the purest form of bullion at honest to God prices, how to test it for purity, how not to get cheated. Everything that you wanted to know about how to buy bullion is there in that video. Now, you also need to understand that you're investing in bullion because you want to safeguard your money from the high statistical beta or price volatility of financial assets, paper assets. On one hand, you want to get out of volatility of paper assets and bearishness in paper assets. On the other hand, you want to buy bullion in paper form. It doesn't make sense. Oil and gas will continue to gyrate due to seasonal factors, as I explained to you in the weekly market roundup segment, and much will also depend about the equity market outlook on how much of the open interest is rolled over on expiry day in the week ahead. The higher the rollover percentage, the better will be the outlook for the market, and vice versa. Friends, if there are any more ideas that I need to share with you, I'll happily do so on my Telegram channel and of course the WhatsApp and YouTube community groups there. But the Telegram channel remains the flagship place where you should connect with me. Contact coordinates in below the video itself. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comments segment, do let me know how my videos are helping you and what you would want me to record in our next videos. Also, please share my videos with all your friends, family, and social media groups to enable me to reach out to a wider audience and help them trade and invest with a data-backed mindset. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable weekend. Take care. Bye-bye.